Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of August. Before we get into August, I want to take a quick look at the market performance in the month of July. If we take a look at the performance in July, we can see here that the S&P 500 was up 2.3%, a nice healthy return. Look at emerging markets. It was down over 6% last month. That had a lot to do with the Chinese stock market underperforming because of Chinese policies on listed stocks having a negative impact last month. We can see here that the small cap index was substantially negative at 3.6%. The Canadian stock market was slightly positive, not nearly as didn't perform nearly as well as the S&P 500. If we take a look at the S&P 500 itself, we can see here that the broad trend line, this blue line right here, that's really around just over 4,300 at this point, it goes all the way back to September of 2020, is still intact. So the S&P 500 is still in its upward trend line. I apologize for this chart being a little bit pancake, but I wanted to put on a number of slides here to go through a couple of things. But if we take a look at the next line down, next panel down, this is the RSP versus the S&P 500. Now, the S&P 500 is a capitalization weighted index, which means that large capitalization companies get more of a weight in the index. The RSP, on the other hand, is a equally weighted index. And that's the equally weighted S&P 500. Each of the 500 companies get an equal weight in the index. Look what's happened here. We have seen this underperformance of the equally weighted index relative to the S&P 500 that really started in June. And really what that's showing is that market breadth is deteriorating. I mean, there's different ways to measure that. You can look at the stocks trading above the 50-day moving average. You can take a look at stocks advancing versus decliners. But this is just a simple way, an equally weighted index versus a capitalization weighted index. And we can see here that we have seen some deterioration in market breadth. This next panel down here and the third panel down here, you can really see that here's the beginning of May, when stocks tend to start to weaken a little bit. We're slightly above that position right now, but overall we've seen this up and down movement for the S&P 500 and really have not gone anywhere for the equally weighted index since early May. If we take a look at the S&P 500, looking at a couple of moving averages investors follow, the blue line here is the 50-day moving average, which is just slightly above 4,300 here. You can see, well, it's actually just slightly below 4,300 at 4,297. And that lines up with where the upward trend line is right now. So if we do see a break below that upward trend line, and also the 50-day moving average, we might see some negative pressure on the markets going down here. Also, too, I want to point out the red line here is a 200-day moving average, which is just below 4,000. In fact, it's at 39.51. And that would require a drop from where we are today of approximately around 10%. And 10% used to be a normal drop in the market 2 to 3 times a year on average over the long term. We don't tend to get that very often anymore. We tend to just see the market being supported by governments and central bankers, and then we see some sharp downticks. We don't see the typical run-of-the-mill 10% drops that we used to see. But if we did see that the market go down below this 39.27, 39.51, I should say, we could see more weakness for the S&P 500 on that basis. If we take a look at the sectors of the market, the S&P 500 here is a reference point up 2.3%. Now look at this. These sectors right here are the growth sectors: consumer discretionary, communication services, and technology. Technology was positive and outperformed the S&P 500, but the other two sectors did not outperform and lag the overall market. And the technology sector was actually doing even better up until just towards the end of July, when we saw some earnings actually have a negative impact on the sector itself. But look at the cyclicals. This is going to really surprise a lot of investors here. Look at the performance of the cyclicals in the month of July. All of these sectors here underperformed the S&P 500, and the big loser was the energy sector, down over 8% in the US, which is a huge move down. But what a lot of investors haven't caught on is, if you take a look here at the defensive sectors, real estate outperformed. Consumer staples performed approximately at market. Healthcare up almost 5%, outperformed. Utilities up 4.3% and outperforming. So what we saw was money flowing from the cyclical sector into the defensive sectors, and also too as well a little bit still on the technology side. But this flow into the defensive sectors is saying that investors are getting a little bit concerned right now with the overall market. Yes, lowering interest rates have helped the defensive sectors, just as it also would also help the growth sectors as well. But the fact that defensive sectors are performing quite well here in July is just showing that investors have a little bit of concern with the valuation in the market. They still want to be invested, though. If we take a look at the some of the subsectors in the marketplace, here we can, these are just selected subsectors. Look at steel. Steel's actually up quite a lot, 4.6% now. It's a cyclical sector. So this is interesting, the fact that this subsector of the market actually did quite well. And also, too, as well, metals and mining performed quite well last month at the same time. Now, the steel sector itself and also metals and mining tends to be a little bit weaker in August and September. So investors should be on a seasonal basis. So investors should be a little bit cautious at this point. Gold was up 2.5%. It started a strong seasonal period last month. August and September are the sweet spots for its seasonal trade at this time of the year as well. Home builders perform quite well. I mean, a lot of that has to do with falling interest rates, helping to support the sector. But it's going to be interesting to watch what happens to the home builder sector if we start to see a little bit of a slowing of the economy overall. If we take a look at the U.S. Yield on the U.S. 10-year Treasury note, it has continued to go down even in the month of July. Now, the Federal Reserve keeps spending $120 billion a month in buying securities to help prop up the overall markets, and they're still on track for that. There's not a sign that they're going to be reducing that imminently. They may start talking about it, but right now this is helping to bring down the yield on the 10-year Treasury note, as well as bond investors aren't convinced of the economic growth forecast over the longer term, and so we're seeing the yield overall come down as well. Inflation expectations have come down a little bit. There's a lot of talk of inflation, but inflation expectations have come down a little bit, which over the long term, not in the short term so much, but over the longer term, and therefore that means that investors bond investors tend to push down the longer term, the yield on the longer term bonds overall. So where do we stand right now in the marketplace? Well, I want to talk about August and take a look here. I'm going to use my Thackeray's 2021 Investors Guide, and let's just start by taking a look at August here. This is from 1950 to 2019. You can see here that this is the average month for August. It tends to be a little bit choppy up and down overall on average, and it ends up being a little bit negative. August and September are the two worst contiguous months of the year overall on average over the long term. So August is a month that we have to be a little bit careful with. If we take a look at the daily probability bars here, so that just means how often the trading days were up or down on average. This flat line baseline is at 50%. You can see here it's actually quite volatile. This is more volatile than what you'd normally see in a month. You tend to see more consistency, but a lot of ups and a lot of downs here. And that's actually reflected. I'm just going to skip back here to a volatility here on a separate page. And this is from 1990 to 2019 using the VIX. You can see that volatility at this time of the year tends to ramp up. So in August and September into October, we tend to see volatility increasing. And that lines up with what we're looking at as far as the daily probability bars. Now, if we take a look at the sectors of the market on average over the long term, well, in this case, we're looking from 1990 to 2019. This doesn't include last year yet. The average performance, this is ranked by the average gain in that time period for the different sectors. A couple of things I want to point out here to start off with, and that is that we quickly go into the negative numbers here for the sectors of the market on average. And the only one that's actually positive is the utility sector at 0.4%. You do have information technology here at flat, and then we start to go negative here. And also, too, we tend to see, if we take a look at the frequency of outperforming the S&P 500, the top sector being 63% utilities, and we get 60%, 60%, 67%, and then we start to really drop off here. And the financial sector and industrial sector tends to be two of the weaker major sectors of the market this month. Now, industrials did not do well last month, so we may see a little bit of a regression bounce here for that sector. But overall, and telecom tends to be one of the weaker sectors. Materials tends to actually be another sector. Energy can actually do okay in this time period on a sporadic basis, depending on the time period here. But overall from 1990, it tends to be a little bit weaker. If we take a look at some of the selected subsectors here as well, we can see here that gold. It tends to be one of the better sectors of the month, but really it's only outperforming the stock market 50% of the time. So that's a lot to do with volatility. So if gold gets that trend, it could actually do quite well, but it doesn't mean it's going to do well just because it's at the top of the list here. Biotech. The biotech sector last month was positive, underperformed the S&P 500. It's usually very strong in July. We didn't see that performance at all, although it was positive. In August, it tends to still be positive here and outperform the S&P 500. Home builders here, once again, is at the top of the list, but that can be a little bit sporadic. If we go down here to further down the list, banks tend to underperform. I'm just going to push this around here a little bit here, try and get this up a little bit. I'm going to flip this over. Okay, try and get this. Yeah, so we got banks here coming in at 33 percent outperformance relative to the S&P 500. Chemicals tends not to perform well. The transportation sector, which has been underperforming, this tends to be a very poor month for the transportation sector. It's going to be interesting to see if it changes its overall trend downwards, just because it's come down so far so much at this time. I want to take a quick look at gold here as well, since this is the seasonal sweet spot for gold. If we take a look here for gold, so here's August. Now you can see September. This is from 1984 to 2019. This gray bar represents the average, and the cross represents the median, and both outperforming the S&P 500, which is the diamond here in August, and tends to be positive in August. And September really tends to be the positive month. I do want to say that, and I'll talk more about this in other reports later on, but October tends to be a weak month for gold. For gold bullion and also gold stocks as well. But look at the performance on an absolute basis. 61% positive, 61% positive as well for August and September as well. But those aren't really high numbers, and that's typical for commodities. You still can get some negative performance even within the strong seasonal periods. You have to be very careful. You tend to see a lot of volatility within the commodities themselves. And if we take a look at let me just take a look here at August and September. September outperforms the S&P 500 by 61% of the time. Over the last 5 years, this dot represents gold. We can see here that it outperformed the S&P 500 in August, but not in September. And that's what we've seen. We've actually seen gold actually start to do well in August over the last 5 years, but then start finishing off its seasonal period a bit early. So we have to watch out for that. I know a lot of investors use gold stocks as well. So I want to take a quick look at gold stocks and the performance for this. I'm using the XAU index in this case to represent gold. And for August, you can see here the median is way up high at 1.6% return, 3.4, average 1.6, strongly outperforming the S&P 500. And September tends to also be a good month for gold stocks or gold miners. Look at October, though. You have to be extremely careful on a seasonal basis for that. And look at the outperformance above zero, 67% of the time in August and 61%. And August, relative to the S&P 500, is 61% and 58% in September. So even though September can be a strong month for gold on an average basis, relative to the market here, once again, because of that volatility, it's you just have to watch out for the volatility. And that's true all the time, even in seasonal periods, but particularly for commodities. So where do we stand right now for the stock market overall? We just started the two worst contiguous months of the year on average over the long term, which are August and September. In my last month's newsletter in July, I called this the danger zone, because we're just entering into this period where the stock market tends not to perform well. Now, it can. Last August, we did see an uptick in the S&P 500 in 2020. And then the market sort of fell apart a little bit in September before resuming to go higher towards the end of October, when it started to really put in a strong trend. But overall, on average, over the long term, August and September tend to be two weaker months of the year. And given the overall climate that we're in, we're starting to see market breadth deteriorating around the markets. Yes, we still see the Federal Reserve committed to its dovish policies, loose monetary policy. Sure, they may talk about tapering that later on, but right now there's no talk of that. We do have Jackson Hole Symposium towards the end of the month. It's going to be interesting to see what comes out of that. It's usually bigger, broader picture stuff that comes out of that, but so that could have an impact on the market. Sometimes they will make an announcement regarding policies more specifically if it's needed in that forum. But this is probably a good time to be cautious in the markets, given that we're seeing the market sort of stumble around a little bit here, and it's close to all-time highs, which is a positive thing. But given the seasonal backdrop, and sure, the federal government in the States may come up with more spending initiatives as well to help support the market. But we're seeing less and less of an impact from those spending policies on the market. So we've seen diminishing returns. And, the Federal Reserve, probably a high probability they're not going to announce new policies to stimulate the market at this time. I think that would only take place if we saw some really weak economic numbers really rolling in, or a big stock market correction. So overall, I would say that this time in August and September on a seasonal basis, and looking at some of the other factors, is definitely a time to be cautious. Thank you very much.